Hello, good morning to all. Welcome to a brand new day and welcome to today's daily dose of market insights. I'm Kelvin Wong here, the senior market analyst of OANDA Asia Pacific. So today will be Thursday, 14th of March 2024. So before we start our daily dose, let's have a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we start the short-term technical outlook on the broad-based cross-asset classes, let's have a recap of what has taken shape yesterday in terms of the performance of the broad-based cross-asset classes, and as well as any we call it economic data or news or events that drives their respective performance. So let's start with the benchmark US stock indices first. So what we could see over here is that the benchmark US stock indices has another yo-yo session. What do I mean by yo-yo session? There is no we call it a broad-based positive follow-through on Tuesday exposed US CPI data strong performance, where the Nasdaq actually went up more by slightly more than by 1% or so. So yesterday performance of the US stock market has been rather mixed. The XPX is actually down negative 0.19%. The worst performer right now was the Nasdaq yesterday, down negative 0.8%, whilst both the Dow Jones and the Russell 2000 managed to inch up gains. So Dow Jones managed to close slightly positive at 0.1%, the Russell 2000 0.3%. So yesterday's weakness on the US stock market is being driven by intraday sell-off that was seen in the 7 mega cap stock group. That means we viewed it as a technology cohort excluding Tesla. So what we see is that Nvidia is actually down negative 1%. That's dragged down the entire semiconductor group that you could see on my screen over. And as well, Apple down negative 1.2%. Then you have Meta, Facebook down negative 0.8%. So all in all, right, the net impact over here is that has a negative feedback loop into the Nasdaq 100, which is much more heavily weighted on these mega cap 7 stocks, especially on the Nvidia side of the story. So what we could see over here is a very unclear short-term trend bias in the benchmark US stock indices. So since late last week, we do not have a kind of a clear trend on the US benchmark stock indices. So I mean, you can have one day the Nasdaq 100 outperformed, the other day it underperformed. So these are kind of a signs of, we call it people say that signs of consolidation at this juncture from a potentially from a multi-week perspective. All right, then on top of that, what we could see over here is that we continue to see strength in the German 30 index, which is the benchmark of the European indices. The trend remains intact. So if you look at the German 30 over here, the European benchmark stock indices. So the German 30 yesterday managed to recoup its losses at the start of the US session, closed almost unchanged. All right. Then what we have over here is in the FX market. So in the FX market, what we could see over here at this juncture was the dollar index continue to actually remains rather weak. So like we highlighted in our daily dose 2 weeks, I would say 1.5 weeks ago, since the breakdown of this 103 this level here, 103.70 level, 103.70 level, which is also the 200-day moving average. This former resistance support now turns into a pullback resistance. This break of this level at 103.70 could potentially unleash another much more pronounced dollar weakness coming back into the FX market on the average, because I'm using the dollar index as a proxy of the FX to actually gauge the movement in the FX market. All right. So as you know that dollar index itself do not cover the entire FX pairs. That means they actually, for example, they exclude the Aussie and the Kiwi dollar. Okay, but nevertheless, we could still use this as a broad-based, we call it a study or analyze of the broad-based sentiment in the FX market. So yesterday price movement continued to actually be rather lackluster. So what we could see is that yesterday price movement over here after that initial 2 days of bounce. So this bounce was the expo CPI impact, but after this expo CPI impact, it shaped kind of a shooting star. Then after a shooting star yesterday, we do have a bearish day follow through by this black candle. Okay, so yesterday the dollar index closed down negative 0.13%, and is now threatening to test this near-term support level at 102.70, which managed to be held in place since 16th of Jan this year. Okay, supported, tested 1, 2, 3 days in a row. Yesterday it retest again, didn't break, and right now during the Asia session, it's an attempt to actually retest this 102.70 level. So if you start to see a breakthrough of this 102.70 level, potentially it could actually open the door for more potential dollar weakness going forward. All right, and also despite the fact that over here is that the dollar is actually weak right now, I do reckon it's in anticipation of something that is coming very close to Asia. The data flow is more on the Asia side. Why? Because tomorrow there will be a key risk event happening in Japan. So later I'll share with you more what is this risk event out from Japan, and it could actually impact the FX market as well. Okay, so stay tuned for that. Then, yes, most importantly, the US 10-year Treasury yield, yes, it did manage to tick up over here. Okay, it managed to actually 2 consecutive days of rally. Okay, expo CPI. So yesterday it managed to inch higher again by adding in 4 basis points, but it's still hover below the 4.21% resistance level. This is the key near-term resistance level. So why is this level important? Why this level is important in the short term? Because it's the 200-day moving average acting as a resistance, and as well as the upper boundary of this medium-term descending channel that I drew from the high of 23rd of October last year. All right, so as long as this level didn't surpass clearly to the upside at which is 4.21%, that could also potentially translate to a not so clear-cut rally in the US 10-year Treasury yield, which also kept the dollar's weakness intact. And as well, most importantly, yesterday, gold as well. So gold prices managed to stage a rally yesterday. Okay, right at the 2153 key support level that we highlighted in yesterday's daily dose. So gold went up by around, I think, 20 points, okay, to 2175, 2180 thereabout in the US session yesterday. And what we could see over here is that oil price. So oil price managed to actually stage a recovery. So if you look at my screen, this is the WTI crude oil, West Texas oil, we call it platform. So oil yesterday, oil price yesterday managed to stage a very strong recovery in the last, it's the strongest recovery in the last 5 days. So it added in close to 2%, and the way it bounced, it actually bounces right off the key technical elements, which is the 200-day moving average, and as well as the 20-day moving average after a kind of a retest at this level. All right, so it seems to us that this kind of shape like a mini V-shaped recovery. Why V-shape? Because if you look at the last 2 price action, it's shaping kind of a bullish hammer, then followed by a long-legged doji, then thereafter a positive follow through yesterday. So yesterday's positive price action in WTI crude, which is West Texas oil, is being driven by 2 factors. So the first factor I'll highlight over here is this. Okay, let me share my screen. It's actually number 1 due to this geopolitical risk tension as well. Okay, where was it? Yeah, over here. So it's actually due to this Russell refinery attack. So there was actually a Ukraine drone attack that on the Russia, one of the Russia oil refinery, we call it plant. So that could actually kind of reduce the oil supply in Europe itself. And do not forget, Russia is part of this OPEC Plus that are also still in favor to actually curb supply going back into flowing into the oil, the energy market. And also on top of that, yesterday we do have this weekly US stockpile results released by the Energy Authority, the EIA in full. That's the US Energy Authority. So there was actually a US supply drawdown. All right, so the US crude inventory slid to 1.54 million barrel. So that is the first time the US stockpile declined in 7 weeks. That means, i.e., the US supply of oil starts to reduce as well. All right, do not forget over here is that US is not part of OPEC Plus. So whatever OPEC Plus tries to reduce the supply, the US side of the story by their so-called shale gas technology, they will tend to actually increase the supply to actually even out the situation. So this time around, the US stockpile of oil has been reported to be in the reduction mode at this point in time, and it's the first decline in 7 weeks. So that actually indicate the overall picture is a kind of a supply crunch issue in oil price. So that actually led to a strong rally yesterday in the WTI crude oil, which is West Texas oil, which technically speaking could have a positive follow through after the price reacted off the key technical element of the 200-day and the 20-day moving average that I flashed to you on my screen earlier on. So these are the key things to take up for. And also do not forget over here is that this is more a longer term basis for those who are paying very close attention to the global markets. So this will actually impact the markets. Why? Because Trump has already been named the Republican nomination for this upcoming November US presidential election. So it will set up a rematch with Biden again. So do not forget over here is that Trump himself, he is an advocate of make America great again. So what he could do over here is that very likely we got to see what is his tonality like in terms of aggressiveness to actually ignite another kind of, put away that protectionist policy that got Americans manufacturer. That means is America against the rest of the world, and potentially he could be targeting China again. So with that, right, if Trump were to make this as his campaign slogan, Biden also will not be able to lose out as well, or else Biden was seen as weak in the eyes of the voters. So I do believe that if this coming to June, July, there will be much more reckoning up of this potential protectionist policy in a way to make America, indirectly to make America great again, is to come up policy that support American business, but on the negative aspect of the against the rest of the world, and potentially China could be the punching bag. So this has really starts to play out, especially yesterday. There's actually this news flow that came out from the current U.S. administration, which is Biden. Okay, Biden administration. Biden administration now eyes Chinese shipbuilding subsidies. That means what they claim that China's shipbuilder is actually having an unfair advantage over the US. Okay, so the Washington is looked to at the USW. This is the United Steel Union petition calling up for ship subsidy. Okay, that's being enacted by the China shipbuilders, and China role as a shipbuilding leader in its latest trade war front. Okay, so net all in all, we could see this potential campaign of this trade war point two that is potentially could start to roll out in the second half of this year, as these two, Biden and Trump, try to face off with one another by trying to win votes if they were to campaign on this kind of protectionist policy using China as a punching bag. So that could actually lead to more volatility in the market, especially in the China stock market. As you know that the China stock market right now, in the longer term basis, the economy hasn't been, it's not in a very clear sign of turning around from that deflationary risk spiral, and whatever rebound that we see in the Hang Seng Index or in the China stock market index, the CSI 300, is more related to a counter trend rally rather than the start of a major bullish bottoming configuration at this juncture. Okay, something to look out for as well as we head into the second half of this year. Okay, so this is more of a long-term situation. All right, so with that, right, very quickly, right, before we jump straight into that short-term technical outlook, I want to share with you all one important news that could take shape tomorrow. It's not economic data, it's actually regarding about Japanese firms which increase. All right, so this is very important. Why? To put the stories the short, BOJ is actually looking at these metrics. That means, i.e., how much Japanese companies are willing to increase wages. If they manage to increase at a higher level, BOJ will have much more reserve. BOJ is Bank of Japan. They will have much more resolve, much more firmness to actually bring forward their interest rate normalization policy. That means, i.e., is to solely get rid of their ultra dovish monetary policy, and the first step is to actually remove the short-term negative interest rate in Japan. So a lot of expectation right now they are looking at in the month of April. That means not this month, April, the April BOJ meeting, where they could actually start to scrap off that negative short-term interest rate in Japan, and some may eventually put it as early as next week. So bear in mind, BOJ will also meet next week as well, with the outcome on 19th of March, which is next Tuesday. So why some market participants are expecting next week? Because tomorrow, tomorrow the largest Japanese union will release their first preliminary result of the wage negotiation results that the labor union have with the Japanese corporation. So they will release tomorrow. At what time tomorrow? I do not have the clear time. It could come as early as 8:30 a.m. Singapore time, which is, i.e., the start of the Japanese stock market opens. So basically, there's been very, very rosy, we call it, results on this wage negotiation front that favor Japanese employees. Why? Because yesterday, Tokyo Motor, which is the largest Japan manufacturer by market cap, they actually plan inline increase of 5% or more for this year, for this FY. Japanese work year, they go according to FY, so it's FY 2024/2025. And overall, if you this is the so tomorrow we'll see the release of this one called Rango. Where is it? Okay, before I go, yeah, so March 15, Rango, Japan's biggest labor union federation, released the first tally of pay deals. That means the first preliminary result. And if you look at the expectation, what market is expecting is a 4.10% increase on average, okay, from Rango, and that actually is the highest level since 1992. Okay, which is 4.97% and way above 3.58% average annualized pay increase of last year. So if it comes in being expectation, for sure, that means, i.e., there is a big chance of BOJ to eventually cut the short-term negative interest rates. I mean, scrap it off. That could be yen positive. That means yen strength coming into the picture. So with the yen strength coming in the picture, that is also driving the weakness of the dollar in general. So this is one of the intermarket correlation right now that is playing out right now in the markets. Okay, that means from the Japan side of the story, that means we start to see potential yen strengthening. Eventually, you have a spillover effect of the entire FX market, where we could be a driver to drive dollar weakness going forward. All right, so with that, these are the key data point and key events and the intermarket situation right now that I try to actually highlight to you all the key things. So now let us jump straight into the short-term technical outlook. So let us start with the FX market first. All right, so for the FX market over here, let us start with the dollar. Okay, where was the dollar? Okay, so let us start with the euro dollar. Okay, so let me expand my screen so that you guys could see. All right, so this is the dollar. Okay, so the dollar over here, the euro dollar continue to actually maintain their upside trajectory in the short term. Why? Because price action going to trade higher, higher high, we call it mini higher high within this minor ascending channel that I drew from the low of 14th of February. So no change, still using 1.089 as my short-term pivotal support level. I don't want to target so tight at 1.09 because it hasn't break above the previous minor swing high of 8th of March at 1.097. Okay, it didn't actually have a positive breakthrough yesterday. So all in all, right, what we could do over here is we will still maintain that 1.089 level because it hasn't break through above 1.097. I don't put it so tight on a whipsaw. So as long as 1.089 short-term pivotal support holds, we will still maintain that short-term bullish outlook on the euro dollar. So overall, next resistance to watch after 1.097 will be 110 level, which is close to the upper limit of this minor ascending channel. Only an hourly close below 1.089 here will negate this bullish tone to see the extension of another choppy minor corrective decline scenario to expose the next support level at 1.0845, which is a confluence with the cluster of these three moving average, 50, 200, and 20-day moving average. All right. Sterling dollar. So sterling dollar yesterday traded kind of sideways, but managed to hold above the 12730 short-term pivotal support level. So with this level maintaining, we will still maintain that short-term bullish bias on the sterling dollar. First resistance to watch will be at 1.2825, followed by 1.2880. So only an hourly close below 1.2730 will negate this bullish tone to see the extension, another round of minor corrective decline or extension of this minor corrective decline that is in place since 8th of March, which is last Friday, to expose the next near-term support zone at 127 figure level, 12670 level, which is so confluence with a cluster of 50-day moving average and the 200-day moving average, 50-day and the 20-day moving average, pardon me, and as well as this minor ascending trend line that I drew from the low of 14th of February. Right now, let us take a look at the dollar yen. All right, so dollar yen at this point in time. Okay, so dollar yen continued to actually trade sideways yesterday. Okay, yesterday after that initial sell-off, then it traded sideways. So it's still holding below the 14830 short-term pivotal resistance that we highlighted yesterday. And for sure, if you look at the RSI, okay, very interestingly, the RSI going to shape a very clear lower high, lower high, lower high, lower high. Okay, something like a parallel descending trendline resistance that's being kept around at the 60 level, okay, indicating to us that there is no clear signs of upside momentum, short-term upside momentum creeping back into the dollar yen. So with that, as long as 14830 short-term pivotal resistance holds, we also correspond to the 50-day moving average, also acting as a similar resistance level as well, as you can see in my screen over here. So as long as this 14830 short-term pivotal resistance holds, we will still maintain that short-term bearish outlook on the dollar yen. So right now I do have the a short-term support level to watch. In first step will be this former congestion area over here, okay, which is at 14710, first support level. After 14710, potentially it could break down below 14710, potentially it could expose the 14620 support level, which is also confluence with the 200-day moving average. Only an hourly close above 14830 potentially sees the extension of this minor corrective bounce from the low of this Monday. That may expose the next near-term resistance level at 14880, then potentially as well as 14950, which correspond to the downward sloping 20-day moving average. Aussie dollar. So Aussie dollar, we do have a slight bearish bias yesterday, but however, after what we could see is a strong, there was actually a minor bullish breakout yesterday over here. Okay, so it broke out from this minor descending trend line that I drew from the high of last Friday. Yesterday's during the US session, it broke out. During Asia session, now there's a retest at this level, as managed to hold it. And so with this slight twist of positive element coming back to the Aussie dollar, yes, even though it still remains below that 6650 short-term pivotal resistance that we have yesterday, the conviction to remains short-term bearish bias on the Aussie dollar has been reduced by the latest minor price action development that has taken shape. So with that, I'll be using 66 figure level psychological congestion as well over here, minor congestion, and also correspond to this potentially involving minor ascending channel that I drew from the low of 5th of March. All right, so as long as this 66 figure short-term pivotal support holds, we'll be flipping to a bullish bias on the Aussie dollar. First resistance to watch for sure will be at 66.50, then above it potentially expose a 67.10 level. All right, only an hourly close below 66 figure level will invalidate this short-term bullish bias to see the revival of another round of choppy minor corrective decline scenario to take shape on the Aussie dollar that potentially exposes the next near-term support level of 65.80/65.60 level. So this zone actually corresponds to a couple of elements. Former minor swing high area of 20th of Feb to 20th of Feb, as well as the confluencing of these three moving average that is coming together, the 50-day, 200-day, and the 20-day. So bear in mind the 20-day now is sloping upwards as well, very fast, indicating to us that's also the reason why we will flip to a bullish bias for today instead, because also of this upward sloping 20-day moving average that is hinting to us potential signs of short-term bullish momentum coming back into the Aussie dollar. All right, so with that, that pretty much sum up on the FX market. So right now for the FX market for today, we do have a very dollar weakness, short-term bearish bias, short-term dollar weakness view across the board. All right, then what we have for the benchmark indices right now. So let's take a look at the benchmark indices. So let us start with the Japan 225. So for the Japan 225, it continued to trade sideways below our short-term pivotal resistance that we highlighted, 39,210. So 39,210 correspond to that's we call it this inverted V-shape sell-off yesterday. Okay, then there are also the 20-day moving average, I think, as a resistance as well at 39,210. So I don't know, tighten it right down to 38,960 is a bit tight. So still using 39,210 level, given the fact that it didn't break below this week low. So this week low level. Okay, it didn't break below this level over here, which is 38,370. Okay, so still maintaining that short-term bearish bias using 39,210 level for the Japan 225. First support level to watch will be at 38,100. All right, so only an hourly close above 39,210 will kind of negate this short-term bearish bias view on the Japan 225 to see a potential squeeze up to expose the next near-term resistance level at 39,640. Above 39,640, potentially revisit the current all-time high zone at 40,490/40,690. Okay, that's for the Nikkei 225. And you look at the Nikkei 225 right now, it's still trying to inch down below the 50 level on the hourly RSI. Okay, so indicating to us that there's no clear signs of bullish momentum creeping back into the Japan 225 on a short-term basis. All right, then we do have the Hong Kong 33, the Hang Seng Index. So Hang Seng Index right now is doing that pullback after hitting the extreme overbought level. So price action of the hourly RSI right now is below 50. It has still a bit more room to go before hitting the oversold region. Okay, so this potential pullback could still play out within our expectations. So yesterday we also do mention that we do have a bullish bias, but there's a risk of a minor pullback first. So this minor pullback is actually taking shape. So no change on their key short-term pivotal support to maintain this bullish bias after that minor pullback more or less has hit the oversold level. So as long as the 16,760 short-term pivotal support holds for that potential ongoing minor pullback, we will still maintain that short-term bullish bias within this minor counter trend configuration that is still playing out on the Hong Kong 33 index. So for first resistance level to watch for sure will be close to yesterday's minor swing high area at 17,230. Above 17,230 potentially exposes the next resistance at 17,570, which correspond to the 200-day moving average close to the upper limit of this ascending channel that I drew from the low of 22nd of January, and also as the former area over here. Okay, the former congestion area of 23rd of November and 27th November last year. Okay, this pretty region, okay, this level here pretty much clear as a former congestion area. Okay, so only an hourly close below the short-term pivotal support at 16,760 will invalidate this short-term bullish bias on the Hong Kong 33 to see the extension of this minor corrective decline to potentially retest the 20-day moving average, acting as a support level at 16,550. Below it exposes 16,290, which cross confluence with this minor swing low area of 8th of March and also pretty much close to the minor ascending trend line support of this channel from the low of 22nd of January. Okay, German 30. So German 30 yesterday traded sideways. Okay, more sideways, still holding above this because 17,900 level, which is the former minor swing high of last Friday, turns into a pullback support. So I don't want to use this 17,900 level as a short-term pivotal support because it's a bit tight. So I rather use still maintain that 17,790. So in any case, if this minor pullback may extend beyond 17,900, as long as 17,790 short-term pivotal support holds. Why there's a risk that it may extend beyond 17,900 because of the RSI. The hourly RSI is now has broken below the 50 level mark, and it has still some more room to go before hitting the oversold region. All right, so there could be a risk of breaking below 17,900 based on the current observation of the RSI trajectory. All right, so as long as any potential pullback managed to hold at the 17,790 short-term pivotal support for the German 30, we will still maintain that bullish short-term bullish bias on the German 30, with the next resistance level to watch will be at 18,050/18,100. Only an hourly close below 17,790 will negate this bullish tone to see the extension of the minor corrective decline to potentially revisit the next support level at 17,650, which is the minor range support level of 5th of March to 7th of March, and as well as the 20-day moving average that maybe is likely soon to act as a support level as well going forward at 17,650 because it's actually inching upwards. Okay, now with that, let us take a look at the US market. So US market, the Nasdaq 100 continue to be trapped within this neutrality range that we highlighted yesterday. Yesterday price action, it peels up but then goes above the 18,335 level, the upper neutrality range, and thereafter it managed to see a bit of profit taking. We came back down close to the 18,035 before shaping a minor bounce up then throughout the later part of the US session. So with that, for sure, these two are the key levels to maintain this kind of potential rangy configuration short term for the Nasdaq 100. So with that, and also plus the RSI is not so fantastic as well. The hourly RSI managed to inch down below the 50 level mark. All right, this is the hourly RSI. So with that, no clear signs of upside momentum coming back into the US Nasdaq 100. So with that, we will still maintain that neutrality bias on the US Nasdaq 100 or Nasdaq 100 between 18,335 and 18,035 for today. Then what's up for the Dow Jones Industrial Average? Okay, so US Dow Jones Industrial Average yesterday managed to outperform clearly by shaping a series of higher high and higher low, and yesterday it managed to broke out above the upper neutrality limit. So we do have a neutral bias yesterday, but yesterday it managed to clearly broke out above the 39,100 upper neutral limit, retested this level before shaping a minor recovery throughout the close of the US session. Then thereafter it just traded sideways in the Asia session. So with that, for sure, this level here, 38,930, seems to be a very key support level to watch. Also very close to the lower limit of this wick candle yesterday. Okay, very close, and also close to the 20-day moving average, I think, as a support level. Similarly, at this 38,930 graphical support level, which is the former minor swing high of 5th of March and 8th of March, turns into a pullback support. All right, so right now, as long as any potential pullback, minor pullback, managed to hold at this 38,930 short-term pivotal support that I have for today on the US Wall Street 30, we'll be flipping to a short-term bullish bias again on the US Wall Street 30. First resistance level to watch will be 39,400, followed by 39,600 level. All right, which is the upper limit of this minor ascending channel that I drew from the low of 14th of February. Only an hourly close below 38,930 will see another round of choppy corrective decline action on the US Wall Street 30 that negate this bullish tone to expose the next near-term support level at 38,660, which is close to the minor swing low of 12th of March, and also confluence with the lower limit of this minor ascending channel that I drew from 14th of February. All right, so overall, what we could see in the short-term technical outlook across the board for the major stock indices is a rather mixed picture. All right, now with that, let us go to commodities. Let us start with West Texas Oil. So this was the daily chart that I highlighted at the start of my presentation today, a strong bullish candle after a retest of the 200-day and the 20-day moving average. So this is a daily chart. So with yesterday's strong price action, we'll be less convinced to see another round of choppy decline back towards 76.20, 76.75, 75. So with that, we'll be flipping to a bullish bias instead on the West Texas oil in the shorter term for today. So using 78.40 for sure, which is confluencing the 200-day and the 20-day moving average, as well as this breakout level that was seen yesterday, turns into a pullback support for now. So as long as any potential pullback managed to hold at the 78.40 short-term pivotal support that I highlighted today, we'll be flipping to a short-term bullish bias on West Texas oil. First resistance to watch 80.55 followed by 81.65. Only an hourly close below 78.40 will turn the tide back towards the best for another round of choppy price action on the downside to revisit the 76.20/75.75 support zone, okay, which also confluence with the upward sloping 50-day moving average. Then for sure, gold. So gold continues to be remains firm due to dollar weakness. So for sure, the 2153 short-term pivotal support no change. So this was the level that we maintained in order. The level that we highlight to maintain our bullish bias. So as long as 2153 key short-term pivotal support holds for today, we still maintain that bullish bias on spot gold XAU/USD. First resistance level to watch 2200/2210, followed by 2220, 2230. Only an hourly close below 2153 level will invalidate this short-term bullish bias to see the start of another round of minor corrective decline to expose the next support zone of 2125/2110 level. All right, so that's pretty much sum up for today's short-term technical outlook. So what other key events to look out for today, other than tomorrow early morning, the release of that Japanese largest union wage negotiation result by Rengo. So for tonight, there will be two important key US data. Okay, let me open up the calendar for you all to see. Okay, so tonight over here, okay, let me go down. Yes, it's the PPI data. So PPI, which is producer price index, so it's something like a factory gate prices in US, where we call it business cost. Is something like more like an indirect looking at the inflationary trend for businesses rather than consumer. So they will release the data at 8:30 p.m. Singapore time together with retail sales. So retail sales will indicate consumer spending. So let's look at the retail sales figure first. So retail sales figure, market is expecting a recovery to 0.8% in the month of February, month on month, from negative 0.8% month on month that was recorded in January. And the core, important will be the core PPI year on year. So core PPI year on year previously is at 2% in the month of January. So market is expecting a slight dip to 1.9%. So if you look at the trend, okay, this is the okay, sorry, this is the not, is this the one? Okay, one second. Okay, let me remove it. Okay, open. Okay, yes, this is the trend. So this was previous one at 2%, 2%. So market now is expecting a dip back down to 1.9%. All right, 1.9%. But however, the clear risk is on the upside. So if the core PPI managed to beat expectation, that means because market is expecting 1.2%, but it managed to beat expectation and it managed to kind of surpass the September level of 2.3% over here. This 2.3% year on year. So it clearly signs to see that the initial broad-based 1 year plus of downtrend may have ended. Okay, and if it starts to come in much higher at more than 2.3% for the month of September, very clearly it's the highest number in the last 1, 2, 3, 4, 5 months. Okay, last 5 months, if it comes at 2.3% or more, above 2.3%, which was last September figure. So if that figure is came in hotter than expected, that could actually for sure see a potential sell-off in the US benchmark stock indices. Why? Because that could actually put that Fed dovish pivot in doubt. That means market is still expecting 3 to 4 cuts by the Fed this year, and that could also potentially translate back to the dollar strength coming back into the picture again. So something to look out for in today's we call it key economic data release, which is at 8:30 p.m. Singapore time. Then after these two data being released, it will be a rather quiet US session. No Federal Reserve officials speaking as well. Why? Because they can't speak right now because they kind of being gated due to the fact that next week you will have the US Federal Reserve meeting on 19th of March and 20th of March. All right, so with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.